Hey guys, Toby Mathis here, and today I'm joined by Chris Streit over at CSA Partners, and we're going to jump into what is going on with the IRS using AI, specifically targeting large deductions like bonus depreciation. So, welcome, Chris.
Hey, thanks, Toby. Always good to chat with you.
And let's jump into our cost segregation studies under fire for all those real estate investors that have been using it. Maybe first off, give a touch of what it is, and then are they under fire, and is IRS using AI to target it?
So I would say generally, yes, cost segregation reports are under fire because there's pretty broad sweeping, I don't know what you would call it, just non-adherence to the audit techniques guide and what's expected in a report. So they're becoming wise. They're being the IRS to that, and they're enforcing it and examining it, and then people are losing. The AI piece is kind of the new wrinkle because that enforcement's been a challenge. The reason this existence was able to populate to what it is today is that reports that didn't need to stand up to an examination typically never had to, primarily because of the resource constrained enforcement group. That resource constraint is still there, but the nuance is they're starting to figure out how to leverage artificial intelligence, just like all of us are in our businesses, to do more with less. And you would expect the people who take the biggest deductions, carry forward losses, high income earners, those are real estate investors. As long as they're doing it right, they're good. But this environment that we're entering into, if a study never had to pass an examination, that's not really going to be the case moving forward, and we're seeing that directly.
Well, let's talk about can you just do a 30-second, what is a cost segregation study and why do people use it? And then we can dive into more of the AI stuff that they're using.
Absolutely. Well, so a cost segregation study is a protective element to enable a real estate investor to take a deduction or claim a deduction on property they own because it's tied to buying property that generates income. And what it allows you to do is segregate the assets that make up that asset into smaller, useful lives, allowing you to pull forward depreciation. So, essentially, you get to take major losses up front that improve your tax position based on the knowledge that certain assets inside of your building are going to be gone way sooner than the entire building itself. That's a cost segregation. Its value exists in the protective element to identify what those assets are, cost them, and put them in a report that has all the proof behind it. So an examiner, if they ever ask you why you took this deduction or where you got the number from, you say, here are all the assets, here's the pictures, here's the video, here's the data.
Yeah, so you buy a property, let's say you buy $1 million property. Let's just say that's the improvement value, not the land. So you pay 1.4 or something like that for a property. You got the land value, subtract that out, and you got like $1 million. You're getting like a $300,000 extra deduction in year one just by doing a cost seg study. Is that fairly typical?
That's a good baseline for what you might expect to see, and that deduction is coming as you're acquiring the property, typically when it's in its most distressed time, when you're getting it up and running. So it's a major incentive for real estate investors, and anytime you see major incentives, you see the opportunities for people to take advantage of them. That's why enforcement's starting to crack down a little bit more.
All right, let's talk about that enforcement. So we have this big deduction. If you're a real estate professional, you're using it to offset everything from your W-2 to other business income. If you're just a real estate investor, you're using it to offset your other passive income. But IRS is now focused on it. What exactly are they using? And like what form of AI are they using to target these studies?
Sure. Well, for they are using they actually acquired Agentforce, which is a Salesforce product. So Salesforce, for those of you who aren't in a selling industry or leverage a CRM, is one of the largest CRMs out there, and they're building agents to help people do things like customer service and help identify where people could go sell more. It just so happens they're also using it for the IRS to figure out where you could enforce more, where you anticipate people are underpaying. It's that model that they're specifically using and growing year after year after year. And where they're looking for opportunities to apply it and point it at is kind of what, if we're using AI in business today, everybody who's listening today, you're asking yourself the same question. And I think that becomes critical with cost seg, Toby, is they started to pinpoint where people are not actually doing it correctly. And they've looked at three things in particular, and those are people assessing the land value appropriately? Are they doing a site visit to get site level substantiated information to use as evidence for the claims that you're making? And are they using live and current cost data from a reputable source, somewhere like RS Means? These all become things that could be asked by the IRS and then summarized by AI. But to the short answer, they're using Agent Force, which is a pretty strong model that's been deployed to multiple organizations and multiple federal agencies, including the IRS.
Now, and are they using it just to flag the audits, or are they using it in the actual audit itself?
So, kind of like the rest of us, the use cases have exploded in usage over the last year. As it began, there's all kinds of challenges the IRS is dealing with. One of them is even just responding to people promptly, as from a customer service standpoint. But the areas where they have evolved to using it in 2025 is to do anomaly detection. They can look at everybody's return and other ownership patterns that they have to look for inconsistencies. Those are their anomalies that they're starting to look for. Obviously, anytime you're dealing with accelerated depreciation, major losses, a lot of assets, but very little income, those become anomalies to detect. They don't make the decision, but they help an agent make the decision. There's still what's called a human in the loop. So it's using that for anomaly detection. But I think right now, the biggest efficiency gain that they get is they have to make a request or a claim to a taxpayer to say, you need to prove something to us. That proof comes in the form of a couple of questions that need to be responded to. Before, those had to be reviewed by an individual, looked and backed up. I mean, that took a lot of time. One of the primary use cases that they have right now is they are able to summarize everything that comes back to them. So just imagine, I can ask for information, and I can have that information all summarized to me, all by an AI agent, and then I can figure out where I should be tackling and focusing my efforts. That's the primary use they have today with AI.
Well, let's talk about the scope of this. So, your firm has done how many studies nationally?
So we've done over 25,000, and we're more, our growth has happened over the last couple of years. We're now at a run rate of 5,000 a year.
Okay, and how many audits are you seeing per year? Just to give an
We
idea.
see we see about 8 audits a year.
All right, so first off, I want to put that in perspective. When you work with a company that does this, even with these tools, you tend to be okay, right? But that's still 8 audits that people are probably like, geez, I wish I hadn't been audited. What are they asking for?
Sure. So, and there's something to the audit element as well. Like, you're going to expect it to happen, regardless. Sometimes, even if there's no anomaly, it's something to go after. The key thing, the big thing to look at is, okay, you were audited. How quickly does the audit resolve? I mean, we've had audits resolve in 24 hours because you provide all the data quickly. And the things that they are asking for real estate investors in the cost seg side, they go in succession, because the goal of the IRS is to get IDRs, which is the requests that they make for you, to you. They want to get those resolved as quick as possible. They don't want to have to do a second and a third and a fourth and a fifth. They want to get it done. The first thing they say is substantiate the basis and give us the contract that you signed with the cost segregation firm, and give us the report that was generated. So all of those things become things for AI to review versus a human. And that substantiation of the basis is a clear first potential loss, and one that I think is happening, in excess of 80% of the time, is, did you go value the land correctly? They ask it because they know most don't, because it's a touchy subject. And it's easy to apply universally and uniformly across the entire tax base.
Well, I know there's people that are using their accountants to do these studies. They're not doing site studies. They are doing things off the internet and like some cheapo plans or whatever the studies that they're doing, and they're hoping that they never have to back it up. What happens to that person when they get audited?
So when an individual like that gets audited, they're going to get this information data request, which is called an IDR. They're going to have to respond to the questions which are going to be observed. So there's not going to be, in that case, there was no contract, there was no site visit. That's what the IDR is going to contain: questions to substantiate those things. Almost like, I'm going to ask you to know that you're not going to be able to have the right answer. And then whenever those things say it was done this way, it was done this way, it was done this way, when those come back and they don't comply with the Treasury regulation or the audit techniques guide, they're going to be losses. That's typically, Toby and I mentioned this earlier. That's typically where we have been engaged post fact to come in and do a cost segregation for somebody who has already been audited, just so it could hold up and they don't lose the entire deduction. But you certainly risk losing it all if you can't substantiate certain things.
Yeah, I want to flag that. So let's say you didn't do the study, you're a little nervous, you're listening to this video and you go, oh crud, I did it on the cheapo. You can fix it. You can get a study done after the fact, even after you're getting audited, and
You,
back it up and support your position.
You can, and actually, some firms bank their whole business on that. I don't think it's a method of good faith, but it's how they do it nonetheless. Where they will just say charge you a upfront retainer of, call it $1,500 or $2,000, and do no site visit, do no land value, and then the moment you get audited, they're banking on that 0.44%. Then they'll go do the study, which is perfectly fine, but it does expose you to a lot of risk. And I said it's perfectly fine. I wouldn't be okay with that, because then once you are, then you're kind of on you're going to be somebody who's observed moving forward into the future. But yes, it could certainly be done after. The cost segregations get a little bit complex and technical. The way I like to make it more simple is we're probably all very familiar with the dependent deduction. If we have a child, we're going to take that dependent. If I tried to take a dependent deduction for 8 children, yet I only have 3, I'm going to try to find a way to find out how I can get 5 of their children. But that probably won't work. You see that if you can go back and substantiate it after the fact, then you're in good shape. But if you can't, then you're kind of out of luck. So in the case, one of the cases, we had to actually inform the client they took like a 45% reclass, and it was probably should have only been closer to 26. They were taking assets that weren't ever going to be eligible for short life. They got requested the data in an audit. And then we had to set them straight that the number they took was way too high and we're never going to get to that number. And even if we wanted to put our thumb on the scale, you're already under audit, they're going to find it. And then you're going to lose all good faith in that process. And they might take away some other things, which is not what you want to do when you're engaged with the IRS. You want total honesty and full transparency.
It's your job to prove your deduction. It sounds weird, but the IRS doesn't have to disprove it. They just ask you to prove it, provide you substantiation. You do that, you win. You don't do that, you lose. And if you lose, you don't want it to be the whole thing. So you want to make sure that you can substantiate a portion. Are they able to target? Because you and I both know there's some bad actors out there in this industry that do these kind of churn out these reports that are way too aggressive with no backup. They're not going to survive an audit. Can they target those people and actually go after the folks that have used them? Or is there a way for them to determine that with AI?
They certainly could, and I think it's probably going to happen naturally. So there's no restriction on doing something like that. But you could imagine if you do have a model or you do have a digital or, an AI agent, and you keep feeding it reports and it keeps finding patterns in the same firms, it's going to get trained and get smart on that. But the other thing too that does represent a risk if you're looking at a firm who doesn't do those 3 things that I mentioned before around the land value, the site visit, and the cost substantiation. There's something in the code called Code 6700 where if it's found that a firm is doing something knowingly at scale, they can go audit every single customer of that firm if they know they're doing it wrong.
And if that's you and you've used one of these and you can feel it in your gut. This was too easy. They didn't really do anything. They make a lot of promises, but yada yada. If that's you, what do you do? Do you just sit there and go, oh man, wait to get audited? Do you go amend? Do you go get the backup study, or are you just prepared just in case you're selected for audit, and then you just know, hey, I better reach out to Chris and company when that happens?
That is going to be up to that individual. I imagine there are certain people who are saying, "Hey, I'm going to let it ride," and the IRS kind of seems like they have a mess right now, and AI is not going to fix everything so quick. But the other thing is, I would, the amended return. I guess it would be how gross it is. So let's say you did take 30% on that example, and you're like, "Hey, I want to do it above board. I never want to have my name flagged. I'm going to go get a legitimate study, or I'm at least going to test to see if the study that I did was legitimate and would hold up." But let's just say it's not, and we're able to identify that with you and for you. We could just have the study there, and that study is doing the job it was intended to do to begin with. Substantiate the claim that you made of 30%. So no new amended return would be required. Now, if you did take, say, a 55% position when it should have been closer to 30, that would be a discussion to have with your CPA of like, hey, here's what we know could be substantiated. Here's what we have at risk. Should I go ahead and try to make a good faith effort, and let the IRS know? It's going to be up to the individual. I wouldn't advise them either way.
Yeah, it's individual choice, but just know. And by the way, I'll put your contact information in the show notes, and you can even do. Here's an idea for people if that is you and you're a little worried about the company that did your study. Go use the link I'll send, and you can do it's basically a free informational analysis, right? Where they'll see whether they're within the ballpark. So you can see using Chris's company, they'll take a look and do a pass at it and see whether or not you're in the ballpark. So you know whether to be nervous or not. And if it's way out of whack, then I would suggest that you actually engage and get the correct information, amend that return so you can sleep at night. But at a minimum, you could do that. Do you guys do anything where you can look at the actual study and maybe take a pass at it and see? Because if the IRS is using AI, I'm assuming you have tools too that you can use to detect the same things.
Certainly. So a couple of things on that front. Within that form that you mentioned, Toby, we start building our audit files before we ever engage. So we build the audit file first before we build the savings file, if you will. We want to make sure that if this person does become a customer, does end up signing an engagement letter, we have an audit file built for them well in advance. So if you did want to look at a property, the first thing we're going to do is look at your land, and we're going to tell you what it is, and we can find that discrepancy immediately. But one of the ways we've targeted to combat this, that we can, aid anybody who did do a cost segregation before, has a report and is worried about it, we've actually built our own internal, what we want to call him like an IRS agent. And he helps us make sure what we're doing is in compliance, but it allows us to feed in other reports, to be able to assess whether or not this report will hold up. But I can tell you, spoiler, many of them never make it past the land. And then very few of them after that make it past the site visit. And then what that allows us to do too is sometimes in these cases, what these firms do is they will take a really conservative amount. They might take 20% instead of 30%.
Yep.
And then they're leaving all this money on the table for you. So we might actually find more money for you to go get, and we have done in very high volume. The other thing, I only mentioned the downside of the land piece where land is undervalued. So you depreciate more than you should, which produces a liability. I've seen equal the number of deals where land should only be 2% of the value, which would have given you more assets to depreciate, but somebody just slapped 20% on it. Um, yeah.
I've seen that with those studies, by the way, and I've seen the electronic studies where they're taking a very, very, very conservative position, let's say 20%. And then you guys have done this where you go in and you look and it's 35%, 40%. In one case, and I'm not saying this is everybody's case, but there was a land use. It was, I think it was a mobile home park or an RV park where most of it was land improvement. And it was like 80, 90%. It was a huge amount that was immediately depreciable. And they're just using the 20%. So it cuts both ways. If you're getting a bad study, sometimes price is not value. I could spend $500 to get something that's of value to me for 1,000 versus if I spent 3,000 and it gave me $15,000 of value. There's almost no benefit in the cheap one, yet there's $10,000 benefit in in doing it the right way. I've seen that a number of times.
Completely. And the thing that I would encourage everybody who watches this, because I know many people, a lot of you reach out, and it's always great to hear from you. But there's a lot of questions that come up, and I think the question someone should be asking, in addition to what exposure do I have, but thinking about the future, is how do I screen? How do I grade whether or not this is somebody who I should be partnering with? And I think right now the standard way to grade is I'm going to look at what's the benefit that they're projecting for me, and then how much does it cost to get that benefit. And I will tell you, those are the two easiest data points for anybody to manipulate to get you to sign a deal. I can just make it 40 or 50%. Nobody's set foot. Nobody's looking at the assets. If you know you're buying this report as your insurance policy and a backup for a deduction that you're taking, you need to be grading based on valuation. How rigorous and how thorough is the firm I'm hiring to value my assets? And if they're starting by not even valuing the land, it makes you question everything else that they're doing. Are they doing it right? Are they doing it just to get me closed? And that's a terrifying thing. So instead of just looking at the benefit, knowing that everybody's dealing with the same thing when it comes to how much they think they can save, look at the land, look at is a site visit done, and ask how it's done, and is all the data being saved, and where is it being saved? Are you taking pictures, videos? Are they geotagged? Are they timestamped so we know they happened in the geography and they happened in a time post the acquisition of the asset? And who's conducting it? Is it somebody in a foreign country or is it somebody located stateside? All these things begin to matter because they end up poking holes in everything that you're trying to do. And then lastly, what's the data that they use to identify the cost? Start asking these three questions. And the last one, just to put everybody else on their heels, I know we're the only firm that does it, so I'd love for you to ask them. If I am audited and you don't do well and I have to pay a lot of money back, what happens then? We refund our fee. I encourage you to ask others, do they do the same?
Perfect, Chris. I really appreciate that. So, hey guys, go into the show notes. I'll put Chris's a link to get a free analysis. What is it? Basically, a free study,
Mm-hmm.
informational study. Or what term should I use, Chris?
Well, so there's two things now because of what's happening here. So we do project the benefit and we show your specific property. That's that there's no cost to that, but we will also show you the start of your audit file, which includes a land to building ratio allocation, which can be used to. So even if you don't use us, take that and keep it because it's going to be some of the most protection you'll get compared to what other firms out there, and that's all complimentary.
All right, I'll put that link in there. There's two other things I'll do. Number one is I'm going to ask you to subscribe, please. It helps the algorithm, and also you'll get great information several times a week on this channel, including Chris here, who's been with us multiple times. In fact, that's the second thing I'll do is I'll put a couple of other Chris's other videos where he talks about cost segs, what they are. Some of you guys are probably scratching your head going, "What is this thing?" You want to learn about it. We've done videos on it, and Chris has gone in and done a great job explaining it. So feel free to reach out to Chris. Guys, share this with anybody who you think will benefit. Chris, thank you for joining us.
Thank you, Toby.